Hey guys, today I'm going to be doing a fairly unique video and we're going to be taking a look at the overall market, the S&P 500, what its earnings are, and we're actually going to run the entire market through my DCF model. It's going to be insane. So, to get into it right away, let's check out the 5-year chart of the S&P 500. And I have it pulled up here. We got 84% returns in the past 5 years with the S&P 500 with a 1.3% dividend yield. So you got to add that onto that as well, which is going to add like 6 or 7%. So we're looking at like 92% returns over the past 5 years. So pretty good for the S&P 500. If you ever wanted to just track the S&P 500, I would recommend getting yourself some VOO, this guy, and it tracks it actually very, very closely over the past 5 years at 84% and a dividend yield pretty much matching exactly the S&P 500. So I would recommend this if you want to match the S&P 500. Now, to get into some of the information, let's check out okay, this is the actual S&P 500 index. 5,200 is what we closed at today. The yearly chart is basically just up and to the right. And I've got some information that we should go over. Let's start with, what do you want to start with? Let's start with the earnings of the S&P 500. So I found the earnings of the S&P 500 over the past 5 years, and we were at $134 out of that 5,200, like 135. I think that's per share. And then it dropped off a cliff after COVID, and then it started to recover when the government put money in people's hands, and it went straight up to $197 a share. And now we are back up to 100. It actually dropped for a while, and then now we're back up to $193 a share. So we're not even quite back up to all-time highs in terms of earnings per share, but the S&P 500 is much higher. Well, not much higher, but it's higher than it used to be. So that is kind of interesting. Also, this chart only goes to December, so maybe now since we're in March, this would be higher. But yeah, that's interesting to me. Uh, we then I looked at the past, I don't know, what is this, like 20 years uh price to earnings ratio for the S&P 500, and we hover between like I'd like to say like 26 and at the low points like 15. 26 and 15, I'd say on average, like looking at this, right up here we got to an elevated level at about 24. I think that's a little bit too high. And then we got up to a really elevated level at 36 at the peak in November of 2020. And then we've since come down, and now we're trading at around like a 20, 20, 25. If I plug in that earnings number to the S&P 500, I come out to an earnings ratio of 27. So I think we're trading kind of elevated right now. I'd say for a historical average, you'd want about 22. So that's what I ended up using in the discounted cash flow model. I have the debt as well, or actually, yeah, the total market cap of 43.734 trillion, and that's going to help us with calculating the share count. And then we've got, yeah, the debts. So I found this article. It says just 19 companies in the S&P 500 hold 33% of the 5.7 trillion in total corporate debt. So I'm guessing the corporate debt in the S&P 500 is probably much higher than just 33% of 5.7 trillion. So I calculated the debt. I think 2.5 trillion is fair. It might be higher at like 3 trillion for the entire S&P 500. So that's what I used. Going to my DCF model now, let's check this out. So ignore the revenue one. This is not working for what I'm doing. I didn't calculate revenue. I only calculated earnings. So only pay attention to this top one here. And there is no like ticker spider, so I had to put in the manual numbers over here. And if there's NA, then it just uses these manual numbers. And so I put in the market cap of 43.7 trillion, and then I put the price of 5,200 right there. Exit multiple 22 because that's kind of the historical average for the S&P 500. I put the EPS estimate at 192. It probably will be higher at like 197. I think 197 is more fair for that. And then we've got, yeah, the net debt of 2.5 trillion. It might be higher at like 3 trillion, but I just put 2.5 just so we can get a good look here. Earnings growth. So if we go back to the earnings here, they went from $134 a share up to 192, and that's a 7.5% year over year annual growth rate, or CAGR, basically, compound annual growth rate. I used a calculator for that. And that's even with the like massive stimulus that COVID gave us. So I don't know if that's going to happen again in the future or not. But I put that in for I put 7% growth in earnings for the foreseeable future for the S&P 500, and I think that's fair. And using this and a discount rate of 10%, we could say that the fair value of the S&P 500 is around like 40, somewhere in between here, because debt is not necessarily as dangerous. You don't have to pay it off right away, is basically what I'm saying. The fair share price is probably like 4,400. And I'd say if you bought the S&P 500 today, you'd probably, oh, that's 80%, my bad. Let's try an 8% return. Yeah, I'd say about an 8% return, maybe 7. Yeah, I'd say if you bought the S&P 500 today, you'd be expecting about a 7.5% return moving forward, compounded annually, of course. So yeah, I think that's kind of interesting. So this is kind of like a good way to compare all the other stocks in the portfolio. Is if you just bought the S&P 500, you'd probably be expecting about a 7% return. But if you bought certain stocks and you think you could get higher than 7%, then they are probably better than buying just the straight up S&P 500. So yeah, it's kind of interesting. I hope you guys liked the video. If you did, smash that like button, and leave a comment if you have any questions. I thought this was kind of an interesting video. I don't know what you guys thought. If you did, yeah, make sure to let me know, and yeah, hit that subscribe button. I do a bunch of different analysis videos on different stocks. And yeah, hit that like button, and I'll see you in the next video.